Well, Mike Wilson is chief U.S. equity strategist at Morgan Stanley. He says take some profits here because this rally is running out of steam. Mike, great to have you with us. You sound like one of those fund managers that was surveyed by Bank of America Merrill Lynch who are so cautious. So after a China trade deal, it sounds like you think there's really nothing to look forward to in the markets in terms of earnings growth as a catalyst, global growth as a catalyst, not there.
To me, trade has not really been the main issue. It's been a sideshow to the business cycle, right? So let's go back a year ago. What we were really worried about last year was that the economy was going to overheat, the Fed was going to have to go faster, and that would tighten financial conditions, and ultimately that would lead to a margin squeeze, which it did, and a profits down cycle. And so that's where we are. So the thing I don't hear people talking enough about is just acknowledging that the profit cycle is really rolling over in a meaningful way like we haven't seen since 2015-16. Now, that doesn't mean we're going to slip into an economic recession, but our work suggests that the revisions are not done yet. Okay, so let's back up. The reason we've rallied so much, the main reason we've rallied so much is because the Fed pivoted, and that was unequivocally positive. And we've written about that. At the beginning of the year, we said, look, we think the rolling bear market's going to turn into a rolling bottom, right, with the worst stuff getting hit the hardest. This gets back to the materials and the banks and the semiconductors and the home builders and the things that really got hammered, EM over DM, which is a trade we've been espousing all year, value over growth, right, cyclicals over defensives. But now that's kind of played out. And so, like, I agree. What's the next thing to drive us higher? I think you're all right. It's positioning. There is cash on the sidelines. Retail hasn't really come in yet. And the reason why fund managers are holding a lot of cash is because they're getting outflows. Right? Yeah. They're still seeing outflows. And oh, by the way, they're also looking at the same things I am, and all of us are looking at as the earnings are not good. So they're not that excited about the fundamentals. They're saying, I understand maybe I have to play here, but fundamentally it's hard to get excited about a 0% growth earnings cycle for this year.
So in terms of the further earnings revisions, we've already gone through the bulk of the first quarter earnings season. So are you anticipating just more revisions to the full year coming in the second quarter, coming in the third quarter? And what, in your view, is going to be the primary catalyst behind that? Is it going to be a stronger dollar? Is it going to, I mean, yeah. What do you see as the factors?
So all of those. So first of all, the revisions for the first quarter have come down to the point now where we have negative year-over-year growth in the consensus numbers are baked in, which is basically company guidance, okay? But the companies haven't really guided for every quarter. So what's built into the consensus now is negative 1.5% first quarter, like 1 to 2% in the second quarter, maybe 2 to 3% in the third quarter, and this big hockey stick in the fourth quarter of 9–10%. That hockey stick needs to come down. And I would argue that the first, second, and third quarter are going to be deeper troughs. So that's going to transpire probably over the next 30 to 60 days. It's going to be a combination of the fact that sales are going to be slowing materially, the margin story, which I don't think is fully appreciated, and the dollar, as you pointed out, is a lot stronger than pretty much everybody's been looking for, including us, by the way. It's now it's up 9% on a year-over-year basis, which is approximately a 4 to 5% drag on S&P earnings. So all those things are going to combine to lower company guidance probably over the next 30 days.
So we talk about the S&P as the market, but it's 500 or more actually stocks. So within that, though, we're going to have the ones that beat and ones that miss. And where do you think the industries are that are more likely to beat and ones that are more likely to miss? I
mean, that's the right question. The risk now is idiosyncratic, right? So we've had the big whoosh down, the big whoosh up, and it's been a beta trade, let's be honest. So now things are going to sift out. So we're trying to find stocks where the revisions have come down a lot, or they're still really, really cheap and pricing in further cuts. So what we're wary of are sort of some of these high growth multiple stocks where the revisions haven't really come down yet. Retail is one of those areas. Some of the software stocks still look vulnerable in that regard. I would say on the other side, we have stocks that have, are pricing in still a slowdown. I mean, quite frankly, the banks are really not pricing in much of a recovery. They're also going to probably see further earnings revisions. So I think what you want to do is let things come in a little bit, buy the things that are cheaper. That's why we're skewed towards value, EM, and some of the cyclicals. That's where the downside, I think, is priced properly. But even here, I would argue that it's not priced appropriately.
So Mike, how come is it shocking to you that other strategists haven't noticed the falling estimates in earnings or haven't acknowledged them the way you do? You sort of, are the doom and gloom guy or the realist. How come others haven't?
I don't know. I think price momentum has a lot to do with that. I think, what I hear a lot of is the stock's up, so it must already be priced in. And I think I think people are confusing stocks being up because of Fed dovishness and maybe a trade deal and maybe a government shutdown, which I agree is not a big deal, but it makes people feel better. And stocks are up for that reason, and they're not really telling us anything about the trough. I think there's one very different. So there's a comparison to first quarter 16 that's very similar, right? Fed backing off, China stimulating, companies are missing numbers, stocks are going up. but there's a big difference. In first quarter of 16, that was the fourth quarter of negative year-over-year growth. This is the first quarter of negative year-over-year growth, and the comparisons are brutal going forward, meaning 20% growth comparisons. So it's apples and oranges on that comparison. That's why I'm not as excited about the full year growth. Our guess is it's going to be a flat earnings growth year for the S&P. And so you got to find the companies that can grow in that environment, which aren't overpriced. A month ago, that was easy. Today, I think it's harder, but that's the challenge.
Year-end bull case is 3,000. Year-end bear case is 2,400. What's your year-end base case?
2,750, and that's the narrative we've had for a year.
Just head home at this point.
Yeah.
Well, not really, because there's going to be some great trading opportunities, right? It's a big range, and so I'm waiting for the next big pullback. I think there's going to be a great opportunity, just like there was in January. So that's where we are.
All right, Mike. Thanks. Mike
Thanks for
Wilson.
having me.
Guy?
Yeah, Mike sticks to his guns, and he does very thoughtful work. I think that's Steve's point. And it's interesting because, Apple gave that warning. The stock traded on 145. Not a lot has changed. Stock's 170 now. Skyworks on the back of it, we talked about. That came out and warned when it was 78. It's 83 now. So you have to say to yourself, maybe there's pricing in such good news. To Mike's point, there's bad news coming. So I think, again, the market's ahead of its skis.
We goodbye the guest.
I've thought that I didn't bring him back. I mentioned Mike by name.
He's still there, but just don't continue referring
It's
to
rude to
Mike.
talk about him when he's still here, but go ahead.
I lost my train of thought. No, my point is this. I think I've thought that we're going to see a pullback for a while, but I'm going to stick to my guns. I do think we're going to start to roll over.